halt there. So anyway, again, for those of you that just jumped on, thanks again for joining us this morning, this afternoon. As I mentioned, this is Greg Olson with Optima. John Solomon's with me, who you'll hear from in just a second. A lot of you guys have, since the meeting last week in Orange County, have received phone calls or emails from myself or John or a number of the people on our staff. First and foremost, I just want to thank everybody for taking the time out of your guys' busy schedules to join us. We've got a lot of positive feedback from a lot of you that were at the meeting, so I hope to continue to build those relationships with you guys. I know it takes a lot for you guys to take 2 days out of the field, so we definitely appreciate that. But really what we want to do today, again, you guys heard me at the meeting talk about, we don't do webinars just to do webinars and talk about our products. Here's North American new IUL, and here's what it does. When we deliver content, we want to make sure it's something that the agents that we work with can actually continue to take to the field and put into their practice. That being said, what John's going to cover today is just some extra information that we didn't have time to cover during the school. And at the end, what we want to do is make sure that if you guys have questions or comments or any other topics that you guys feel that you want to take a deeper dive through, let us know. If you don't utilize the chat feature on this call today, pop me an email, pop John an email. Chances are we've probably done a presentation on it, and if not, we can probably build it. So we're here to help you guys learn and grow in any way that we can. So with that being said, I'm going to quit talking, and I'm going to turn it over to the maestro, Mr. John Solomon. So
the maestro. Thank you, Gregory. Well, good morning, everybody. A couple things just to tee off on what Greg was saying. New topics. I've been doing this for 26 years. I just have a lot of crap up in my brain. Tons and tons of presentations I've done over the years. In fact, some of the stuff that I did actually dug out from some of my trip, my 3-ring binder that I got when I went back to New York with MetLife back in 1988. But I put together just tons and tons of information. So if there's anything that you want us to cover, specifics, things that we dove into, that maybe we took you from a 50,000-foot cruising level down to 10,000 feet, but you want to be parked at the gate with a particular subject, things like illustrations, things like variable loans, things like whole life, and more into that, more detail. I can't take every subject that we covered and literally park everybody at the gate with all the knowledge that I got and that we've collected over the years in the presentations, because we'd be at one of those presentations for one of the seminars for a week. And so what I did is for this deal, it's not going to be very long this morning, I've just come up with a few ideas and things that I've learned over the years. And most of you, I'm not sure if you're part of an IMO or a BGA, or if you're literally just working out of your garage, you don't see the number of cases that I do and all the little issues. So I got a couple of things I want to just go over today, some warnings, things to be on the lookout for that I've just come across. And I do call this tidbits. And as you guys are probably all reading this first screen, these are just some lines that I think that they're cheesy and there's some good ones. But I'll just leave these up there because these are things that kind of struck me over the years. And the first one I really like. I got a group of guys that I work with that their whole model is working with doctors. And I was up at a meeting last year, and this guy started his presentation to his group of agents with this line. And it just struck me. I literally was sitting and I wrote it down on my napkin. I just love this line. We want to give you security and confidence, not worry and stress. That works for me, saying it to you guys, and it works for all of you out there with your clients. I just think that's a really powerful, and I hate to use the word, it's a line, but it's a power phrase, and it's something that it kind of wraps up our whole concept if you're selling Index Universal Life. And then you can just read these other ones here. You don't buy life insurance because you're going to die, but because those who you love are going to live. And I know they're cheesy and they may not fit into all of our personalities, but the one thing that we all have in common is we always run into Dave Ramsey and Susie Orman, and they are big fans of life insurance, but of course they're fans of the term insurance. And I hope that everybody really understood and tracked my little presentation on term insurance, where I was talking about flattening out the mortality curve, and chat more about that. And that's going to be our next webinar. We'll be going through, literally by term invest the difference. I really want to explain that. I've done some work on that for our next meeting and made a couple slides just to explain that in a little more detail. I did talk to quite a few of you at the breaks and after, just to go through, how that really does work. And in a nutshell, you can't say, hey, here's a 20-year term that's going to cost $1,000 a year, and then take that 1,000, put it into a UL. You literally need to put 1,500 in, and then it does work. And just to refresh your memories, and it's a powerful sales tool, is that if you're going to pay $1,000 for term, why not go pay $1,500, $1,600 and have that extra money that the insurance companies are keeping in the early years go into a savings account for you. In other words, instead of overpaying on that $1,000 term, that $700 difference in the first year the insurance companies are absorbing that, let's take that and put it into our own pocket. And with that, let me just flip over to some of the key bullet points that I want to just go over today with you guys, and things that I've learned over the years that you need to know when you're selling these policies. And I want to discuss a little bit about each one of these bullet points. This is one that I've learned the hard way. Never, ever, never, never, ever roll a policy over until the new one's in force. And I actually had a guy was running in Scottsdale, and they were in the middle of a rollover. And they canceled the policy, and they were not doing a 1035, and there was about a 3-day lapse of coverage there, and the guy died right in between that. I think we're all pretty aware of that. Most of us are doing 1035s to avoid that when we're rolling an old policy or replacing a term policy. You just got to be careful of that, because I've actually had a case happen. But the next one's a little more relevant, and I want to make sure we really cover this, because this is something that I mentioned in the school, and I want to make sure we all get it, because I run into this all the time. In general, I'm not a fan of 1035ing out of an index policy. I've seen some of the LSW policies that have 5% caps. I've seen some of the F&G policies that have 8.5%, and then I've seen some of the old Avivas that are literally down at 7%. But there's two sides to the story on those. Just because the cap's lower than ours is not necessarily a reason to replace it. The first Ameris IULs didn't have per thousand charges. They were amazing products. And even though they're at a smaller cap rate, you need to be really careful of that, replacing those, because the fees are so much smaller. But the whole point of this particular bullet point is this. If you're going to go 1035 something, and that issue date is November 15th, and they've got a 10.5% cap, and they're about to get a 10.5% cap in November, and they have $40,000 in there. If you 1035 that today versus waiting until November 16th, you just took $4,000 away from them. So again, these are just my little tidbits that I just want you guys to be aware of as you're going and selling policies, and just things that you need to be careful of. The next one, talking about banding. You really need to pay attention to this, because certain companies band their policies at $250, some are at $500, they could be at $750, they could be at $1 million. And the whole point is this: if you're selling someone a policy and they have one in place and it's $870,000, just be aware that if they're preferred, a $900,000 policy can literally be the same price as $1 million if there's a band at $1 million. And for those of you that don't know what a band is, it's basically a quantity discount. But the metaphor is, you're pulling up to Costco, and out front you buy a Coke, and it costs you $1. But you go inside and you buy a case of it, and you get 24 of them for $6, right? The more you buy, the cheaper they get. And term insurance and life insurance does work the same way, so you gotta be careful with that. Another thing that I heard a lot after my presentation was just talking about funding these policies. Well, John, you talked a lot about max funding these policies, and you're using it as a savings plan, and I was just trained to sell this thing at 10% over target, thinking that I was overfunding it, or 20% over target. And it's just, what is target? Target is nothing. It's an inappropriate starting point. It has nothing to do with funding the policies. It simply has a one value. It's how we get paid. Now, back in the day, some of the original ULs, target was basically set so that at a certain interest rate, it would endow. And I think that a lot of companies have got away from keeping that in mind, but where, if you got a 6% rate of return, target would endow it. And that's kind of where they started, and that's where they paid us. But that's kind of gone away. And I love this next point, because it's really important to understand. The IUL death benefit will be locked by one premium if it's max funded. And I want everyone to be aware of that. I mentioned this a couple times at the school, but it's really important to understand that if you got a guy and you're trying to get him to really max fund this policy to the utmost ability of his particular budget. What I'm trying to say is if this guy's going to put in $500 a month and he can afford $500 and not a penny more because you're really taking everything from him, if something changes in his life, you don't have any flexibility, because 1 year of paying that MEC premium absolutely locks that death benefit. So what I'm saying is you pay the first year. If the MEC premium is $1,000 and you paid $1,000 and you've got your $275,000 death benefit, and next year he wants to pay less and lower the death benefit, you've locked him. You can't lower the death benefit. So just keep that in mind, because that happens a lot. I get that question all the time where they actually want to come in, and even if you are able to lower the death benefit, because maybe we didn't max fund it at a 7-pay, maybe we put a guideline premium in there or something, remember that a lot of these carriers, when you lower the death benefit, may lower the death benefit, but not necessarily all the fees for the first 5 years. And that's just something that I want you to come to me with when you're analyzing someone's portfolio. Let's go through it, and let me just help you guys take a look at what's out there. The next one I think is really important, and this is something that Scott Kellen from Allianz illustrated for us. And hopefully you guys have played with some software. And if you haven't, put that on a note, send us an email, or tap into Greg here on the question tab, because one of the new topics should be running quotes. And I really believe playing with the software teaches us a lot on the magic of compounding, the eighth wonder of the world, and teaches us how to use these policies and be really efficient with the flexibility in them. And I like to just talk about this, because remember the one thing that Scott had preloaded was, say, if you paid $275 a month, the policy basically had 0 at age 100. But if you paid $300 a month, all of a sudden it went through the roof. And it's just the magic of compounding and playing with these numbers. And I really want everyone to understand that. And if they don't play with the software a ton, let's just spend a half an hour together on the phone and let me just walk through all the software for you and just make sure you guys truly understand that, because it's a powerful opportunity. The next bullet point is an important one when you're trying to really cram a bunch of money into a policy. And this happens a lot. If you just say you got a policy, it's got $250,000 death benefit, and maybe it has $150,000 of cash in it. Well, when you're rolling that money over, even though the cash comes in and dumps straight into the cash value, you still have to divide that cash value by 7. And if that number is bigger than the 7-pay, you're going to have to increase the death benefit. I know it's probably hard to follow on the phone, but the bottom line is, if you have to stuff a bunch of cash into a policy and you're just trying to roll over 1035 from an old one, and the death benefit is solving for a much higher premium, a much higher death benefit, that's a great place to use the term rider until we've satisfied the MEC guideline. And that's something that we can help you guys run. But if you're playing with the software yourself, it's something we mentioned in the school. I had a whole slide talking about it, but this is just something I've ran into twice yesterday. Actually, we were working with a couple of big cases. I talked to 2 guys on a variable. One of them we didn't have to do because we were working actually lowering the death benefit. But it's just something to keep in mind when you're running these things, that a term rider is a great way to allow a large amount of money to come in more efficiently. It's something I talked about quite a bit on how the whole life design is. We have the base policy, and you have paid up additions. We want to see a big percentage of that money paid up additions, and you can get a bigger percentage if you take the base policy and add some terms so you can stuff more cash into it. The moral of that quote is, of that bullet point is, let's just simply do what's best for the client and make sure we get the most money in there, and sometimes a term rider is the best way to do it. This is something I just ran into yesterday, the second to last bullet point. The loans are tax-free. They're not interest-free. If you take a wash loan, that wash loan does stay on the books, and it aggregates itself. It's just it grows and grows and grows and grows. I had a guy just yesterday call me up, and they've got a policy that had a 8% wash loan for the last 20 years, and that $200,000 loan is now an $800,000 loan. The policy is about to lapse. Guess what? He's going to get a monster 1099. Another one of my buddies that I've known since freshman year in high school was just telling me on Monday, he got a client with a 1099 for over $300,000 that he's got to pay because his policy lapsed after a long period of time with a loan on it. So keep that in mind when you're looking at some of these old whole life policies. If there's a loan and they look like they may blow up because they're not paying anything on them, very important thing to understand. And the last one here, this trust-owned insurance. less than 50% of these guys out there that went out and put something into an ILET are actually filing their crummy letters. And there's some new rules coming on it, but I work with the trust administrator, and he will. I'm going to invite him on one of our webinars just to chat about what's happening out there in the estate planning world, especially if you have corporate-owned policies. They're not filing their 101Js, and they're getting themselves in some trouble because every one of those gets audited. And there's about 3 or 4 things you really need to understand, but that's not something we've actually covered. And if that's something you want more information on, again, zip us an email. I'd love to chat with you about the intricacies of trust-owned life insurance and corporate-owned life insurance. But I just want to say this. It's a very complicated subject, and we do work with a very powerful trust administrator that can help us understand and do a lot better job analyzing portfolios when you look at it. Now, the next little bullet point here is something I talk about quite a bit. I just went to. This is important to me. I told you guys a couple of stories about some of the guys we've worked with, and if you guys want, I'd love to show you something that the Department of Insurance in Iowa just stuck out. And they said there's a lot of IMOs that are leading clients astray. And this came from the Department of Insurance, saying, hey, and they were basically warning the insurance companies that, hey, if your IMO is representing your company and sending bogus illustrations out, then you're responsible. So we're going to see a lot of changes here real quick. And I talked quite a bit down in Orange County about the changes and how we're going to be limited in what we can illustrate. And I love this line because, one policy can never make your career, but it can certainly break you. If you're trying to sell that one dream case, I really want to talk to you about it. Let's just make sure you're illustrating these things properly, because I've seen way too many guys get caught up in the $100,000 target premium and up, getting really excited about this opportunity. The IMO made a pie-in-the-sky illustration for him, and it just kind of, I don't know, I'm not going to say it breaks my heart. It just saddens me, though, because I see these illustrations that I think are unethical, borderline illegal. And Rocky talked about some of the programs, these IRA rescue programs that people are running around using, and really not understanding what they're showing. This is the next bullet point, is a nice little tidbit that I really want to talk about, because too many times we're out there talking about liquidity in these policies. And the first warning I gave in the class was, look, if you're rolling over $50,000 and then you're only going to pay 10, just by definition, you're kind of underfunding from year 2 and on. Let's not exacerbate that by paying 10 more in the first year. So we actually have $60,000 in the first year, followed by $10,000 in year 2. And then the other side of that's true. Think of it this way. When someone's talking about paying $10,000 a year just for the next 5 years, and they want to start out and have to pay 10, 10, 10 with no rollover, remember this, that if they're not going to be paying premium, consider that part of the liquidity. I had an agent we were talking with a couple of weeks ago, just before the school, and I think it was a $20,000 a year premium. And we were just saying, look, there's not a lot of liquidity in the first couple of years, but if he's committing to $20,000, and in year 3 he's looking at the policy, I paid $40,000 in, I pay my third premium, there's $60,000, I've only got $45,000 or $50,000 in cash value. The point was this, that hey, if you don't pay that premium, that's another $20,000 that we can think of as liquidity if we don't put it into the policy plus what's in the policy. And it sounds like a dumb little line, a little thought, if you will, but it actually helped him get the case. The webinar scores, I talked about that down there, and that's not such a big deal. But show $100,000 premiums. For those of you that have never sold one, you'll never sell one if you don't talk about them. And for the guys that can afford it, don't be afraid to show $100,000 premiums. If someone's talking big and they've got a lot of money, and you're trying to just get a $10,000 sale, you'd be blown away what happens when you show them. I have a great story. I have an agent that was working with a guy for 3 years, and he was trying to sell this guy a $20,000 policy. And the guy that I work with the trust administration with actually met the same exact client through a different channel. And by the way, my guy's in California. The other guy that was trying to sell this guy was in Vegas, and the client was in Michigan. And because he went in and showed him a $250,000 policy and showed him the intricacies of having it owned by a trust and being able to deduct the interest coming back out of it for business loans, that one little twist got this guy to write a check for $250,000 a year when this other agent was just going in there and showing him, 1/10 the premium and could never get him the close, because 1/10 the premium didn't affect this guy's life one way or the other. And that's actually a very good story, and it kind of ties into what I was mentioning with the trust administration people and how they can put these policies into trusts. Companies can borrow the money out of these trusts, and it's a tax deduction when it comes from the trust. Imagine the leverage out of these policies when you can take a tax deduction for the interest on them. That's very, very interesting. The next one, the last one, is really the one that made my career when I was in the field. I was never comfortable. We used this Tom Wolfe system for tracking and for coming up with death benefits, and it was a whole career distribution that this guy put together. And he had this really cheesy line that you were supposed to tell your client that, hey, we get paid in 2 ways. First, by the business we're going to do here today, and then, of course, by the referrals that I'm going to get from you. And I just was not that guy. And one day we were talking, I was talking with a couple sitting around their kitchen table, and we were just talking about the trust and what was going to happen. These two were traveling quite a bit, and they had young kids. What happens if both of them went? Well, they wanted her sister to have a policy, take the children and get the money. So the sister became the contingent beneficiary. And I just said, well, why don't you call your sister, let's put her down here, and just tell her I'm going to call her. And I want to have a conversation with her just to tell her, I want to introduce myself, because obviously if her and I ever talk, it's going to be a really nasty situation when they don't want to discuss, and it doesn't need to be a stranger reaching out to them. And by the way, if you could just tell them about the work that we did here today, it makes that call a little more interesting. I could tell her about this, and maybe I can do something with her. And just by having that conversation, that changed my career. That was the ultimate watershed moment. That worked so well, I kind of just fell into the contingent beneficiary referral. Most of us leave that blank on an application. And if you're sitting with the family member, if you're sitting with mom, you're sitting with dad, you're sitting with both, you need to find out what is going to happen if they're both gone. Where are those kids going to go? It's going to be a close family member, a very close friend, more than just the next door neighbor. And it's someone that these people, love and cherish, and will absolutely want you to get in touch with because of that line. Hey, if something happens to you too, I want to be able to reach out to him and have it not be the first time that we chat. And by the way, again, tell him that we had a little conversation and maybe I can do some work with him. I tell you, it's not cheesy. Put it into your own words and use it. These next couple of things were just a little bit of takeaways from the school. Talking about UL, the big difference between universal life in general and whole life. How many times did I say down there, guarantees are expensive and risk is free? But I just love this idea that anyone that's thinking about buying life insurance and wants to have it, and we're working with a whole life opportunity, trying to replace a whole life, you're in competition with a whole life, I just want to make sure you guys really understand that these policies do have a little more risk because they're not completely guaranteed, but for that additional bit of risk, you have a significant upside potential. And I'm not sure if I put this bullet point up. I had it on a couple slides and I thought I took it out, but hopefully I mentioned this, that that you really need to have a couple of different presentations. And as you're getting to know somebody, if they're sitting in your office and you're in the small talk, if you actually went to their office and you see what's on their walls, if you're in their home and you see what they have on their walls, and you can kind of get to know them a little bit, you'll quickly be able to figure out if someone's analytical and really wants to be educated that way, right? The analytical client tends to be more interested in how the watch works, not what time it is. Really get into them. But then there's other people that are more, concept-driven. They're the guys you can grab a napkin and explain it to them. And hopefully you have a presentation in mind for both of those types of clients so that you can really find out the best way to get them to understand what it is that we're showing them. And then this next slide is interesting to me because we need to understand multi-life contracts. And I've got this call a couple times. It's not forwarding. There we go. I hear a lot that, hey, I want to use a last-to-die contract to really leverage the concept of cheap insurance and maximizing the cash accumulation inside of these policies. And there's just a couple things you need to understand about that. I'm sure it works really well because the relevant age is the person that's younger on the contract because the cost of insurance is a little bit lower. But also remember, on a second to die, you can't solve for as small of a death benefit. It's a bigger death benefit. So it does take away some of it, but it also does take away that, hey, usually we're doing this on the primary wage earner. So let's not forget that these things are insurance. I keep hearing this. There must be some IMOs out there really promoting second to die. And I want you to, if you're one of those guys or gals that really wants you to look at both sides of it. Some other things that have come out, there's two companies that have these first to die products. And just think about it from an actuary standpoint, trying to price two people dying. Second, it obviously makes sense. We know that one of them's got a better chance to live longer than the other one. We can give a little bit of a discount because we're not going to pay anything to the second death. But on the first to die, how do you actually calculate that? There's no mortality tables for a first to die policy, and it's more guesswork, which is why a lot of companies don't have them, and they don't really price them properly to make it worth the while, in my opinion. So if you guys have sold those types of products, I want to have a conversation with you. And of course, that we don't need to talk about that one. That's not relevant. But the key is to find out where you are and where you're wanting to go. And I want to be able to show you guys how to get there. I know that kind of sounds kind of cheesy, but the whole takeaway from that presentation down in Orange County was, hey, we want to teach you guys how to analyze portfolios, teach you how to understand the products, right? And one of the best ways to do that is if you get in there on the appointment the first time around and you haven't done a good job of really understanding what it is they have, the entire thing, because you went in to talk to them, their referral, just talk about a mortgage on their house, or you went in to talk about some kind of a business insurance. I don't care if you went in there and you sold them, a Medicare plan. The idea is on these annual reviews, we really need to get in there and use those as a time to get to know your clients better and make sure that you're using those for referrals. I can't tell you how many agents we work with that their entire world is based upon these annual reviews. And it's a small percentage of them, but the ones that do well tend to make sure they don't miss out on annual reviews. I wish we could be in a room right now and I could say, hey, how many of you actually do an annual review with every one of your clients? I think it's really important. That was the big takeaway, was just, to me, understanding the portfolios. And again, this is one that I wanted to finish with that I didn't really get to. Talking about annual reviews and, of course, overfunding. We talked about that quite a bit. And this next one is just something that I threw together, talking about these policies to avoid. Obviously, I'm not a huge fan of whole life. I do think whole life works very well for the people that are super conservative, that do want guarantees and are happy with a 1% to 2% rate of return. The accidental death stuff, every study I've looked at talks about not using those policies because they don't ever pay. I remember that one study I showed, the Penn deal, where Penn State talked about 1% of the term policies paying a death benefit. It's exponentially smaller how many of these accidental death policies do. Child policies, kind of a morbid thought. I hear people buying policies on their children all the time. If you're buying a policy and selling policies for their children, it's awesome. I bought policies on my kids just to protect their insurability as they get older. But if you're putting these things on there, the sad truth is this: if a child dies, it's actually a economic, it's a benefit for the family. It's not going to cost them. They're not going to have to raise them. And I keep having people trying to buy the cash value policies and wanting to put those on there. And that kind of obviously eats away at the cash value. And that falls along the lines of the simplified issue products out there. I love it when agents send me some of these Anaco and these other pioneer companies that really go out and push the mortgage market. If you run into any of those policies, their preferred rates are literally table 2. And it's because they're simplified issue. And there's nothing better than stumbling into a product that someone bought to cover their mortgage and they didn't have to pee in a cup. If they didn't get a physical and they're healthy, they bought something because they were stressed, they were just moving in, they had a great sales guy in the room talking to them about these simplified issue term policies and why they should just go out and cover the mortgage real quick. And if they look at what they could buy, you can literally double and triple the death benefits on those policies. And that's just something I didn't get a chance to talk about too much down there. We talked about that slide. We talked a lot about the 1980 and 2001 CSO tables, and we do have a calculator that will actually show you the difference on them. I was just chatting with a guy yesterday that had a variable policy. And in this variable policy, it was a 28% difference between the 1980 and the 2001 CSO table. And this gentleman, I'm 90% confident, is going to be able to go out and write himself a $25,000 target because the policy is old, it's a variable, it's got a lot of risk in it. This new policy's got a cheaper cost of insurance and a much better opportunity for the client. This thing's just kind of fun to read. It's just a little bit about our government and the way we're spending money. I love if you just take our entire situation and subtract 8 zeros. The family home, $21,000 in income, but they spend $38,000. So every year they have to add $16,000 to their debt. This just cracks me up. So their outstanding balance on their credit cards is now $142,000. So what do? They cut their budget by $38. That just says something about our government. I just found that piece on the internet, and it just cracked me up. The next one is just the median income. That's just a little bit of nothing. And I want to end with this, because you guys know how I feel about this. I put this slide up twice. The whole opportunities in whole life, the way they slam our products, the way they talk about their guaranteed cost of insurance. I had breakfast with an agent yesterday here in town, and we were competing with a Lafayette whole life policy. And they took our IUL illustration and yellow markers all over the thing. And look at this, the 7.25% load. Look at this. This is a fee here. Look at this. The participation rate's not even guaranteed. They just slammed the whole thing because why? Because it was completely unbundled. And all I said to the client was, look, we can't even talk about the black box that you're looking at. Read that entire 17-page illustration. Ask your other lady for a copy of the contract, and you read the entire contract. You tell me what the fees are. She's just telling you how everything's guaranteed, but look at your rate of return at 1 to 2% here. The internal rate of return was less than 2% guaranteed. And I showed him ours using just the fixed account at 4.5%. Just the fixed account that paid 4.5%. So using it like a regular UL, more than doubled. So again, my whole thing is for a little bit of risk, you can do much, much better. And I talked longer than I said. I wanted to keep this to under 30 minutes so we can get you guys to keep coming back. So with that, I think I'll wrap it up right there. Greg, does anybody have any questions they put up there? Anything you want to add to finish up?
No, excuse me. A couple of questions I answered, just looking for a copy of the presentation and whatnot. Just on some topics going forward, as John mentioned, one of them being, buy-term invest at rest. Just continue to keep a lookout on emails, and obviously, like we said, we're talking to a lot of you now on a pretty regular basis. One question that I did get on this call today, and I've talked with a few of you, is some software training. I will get that put together very, very soon. Give me within a week. I'll get something put together. I'll get an email out to everybody. We'll probably start primarily focusing on the Allianz software, and then kind of jump into WinFlex or whatever. But I'd rather just whoever can attend it. Come in, and then we'll do a training there.
Let's do both, Greg. I want to throw North American out there, too, but just because their term products are so strong, they are convertible, and it's such an easy software to master. Both those products, I'll say all the companies in general have very easy software to run, but I do also want to make sure that we get North American in front of you guys just because they have such a diverse portfolio of opportunity, not just universal life, but index universal life. And phenomenal term insurance, and then we can, the whole annuity thing's out there too. So I don't want to not show you guys how to use that. I want you guys to understand how to work with them. If there's no more questions, you guys all have my number. In case you don't, in front of you and you want to chat, 415-515-5005. Please call me if you have any questions or anything you want to chat about. Today was just some thoughts that I had that I wanted to kind of weave into the presentation, didn't really get to. Hopefully you learned something, and if we can spend a half an hour a couple of times a month and you can learn one thing, it's better than driving and sitting in a hotel and listening to us chat in a hot room. With that, I think we'll call it a day, and if you have any questions, please give me a holler. Greg, you want to add anything to that?
That's it. Just thanks, everyone, and we'll talk soon.
Thank you.